Hello and welcome. Sean Allison here. Thank you for joining me and welcome to this week's edition of the Cash Flow Options Weekly Market Insights. So, last time we spoke, the skew or the perceived risk of a 2 standard deviation move or more to the downside, in other words, a market crash, was around 170, which was the highest that I've ever seen it. So there was a lot of fear in the market last time I spoke to you. That's now pulled back somewhat to 155, but anything more than 135 shows that the smart money is concerned, very concerned, that the market will crash. So we are still not out of the woods yet. We look at the amount of stocks that are above their 50-day moving average, and we can see that has fallen below 50%. So when you're getting more than 50% of stocks that are below their 50-day moving average, that's a very bearish sign as well. But what we really need to do is we need to look at the charts here. So let's go and look at the charts. And if we look at the SPX, which is obviously the best way of looking at the overall market. Now, like I showed you last week, there are some very big signs here, the skew being one of them, that the market could have a large correction. And that's still on the cards. It always is. But we have to trade what we see and not what we think. So that's very, very important here. And right now, this trend line going back to March of 2020 is still being respected. In other words, the price is still above that significant trend line. We did dip below it one day and then straight away recovered and moved back up above that significant trend line. So that's one thing you need to look for, right? What are the signs I need to look for, Sean, that this market is likely to correct or crash? And how then could I set up a position that has a fixed limited risk and unlimited profit potential, right? That's really the key. And that's how we made so much money in February and March of 2020. We literally printed money because of the fact we knew what to look for, right? And it's what I'm trying to tell you right now. You've got to understand exactly what you're looking at, not looking at the the news headlines and trying to get a general consensus of what the experts think. Look at what the price is telling you, okay? People lie, numbers don't. Look at people's actions, don't listen to what they say. So we want to be able to look at people's actions, which is here in the charts. We want to look at the numbers, which is here in the charts as well. And that's what's going to give us the strongest idea or strongest conviction that this market is going to fall or correct. So the other thing that you want to look at is our opening range, which is over 90% accurate. So if you have a look at this, you got the high here of the first trading day of the month, which is obviously the 1st of July, which is right here. We put the high on that day and the low on that day. Okay, so anything above 4320.66 is bullish, which is where we are now. We are in bullish opening range. Anything below 4300.73 and we are in bearish opening range. Okay, so right now we are in bullish opening range. Now we reset this on the 3rd Friday of the month, which is the 16th of July, which is this Friday coming. So we will reset this soon, but for now, trade what you see, not what you think. And right now we are in bullish opening range mode. We're still above that significant trend line going back to March of 2020. Another thing that I'll get you to look at, which will really help you, is to look at the risk appetite of the market and look here at junk bonds. So if you look at junk bonds and you see this significant trend line going back to October here, you can see that it is still respecting this. Okay, and it's, if you got a daily close below this trend line, that would certainly be something bearish that you need to be looking at, right? So all of these things are together, right? The opening range of the SPX, that trend line that I spoke about on the SPX, looking at the skew still above 135, okay? The 50-day moving average, more than 50% of stocks below that, junk bonds below this trend line, and also high yield bonds as well. Right? Some of the most sophisticated investors and informed investors in the world trade in the bond market. So, we need to be looking at that. And again, this trend line going back to around October, if it closes below that, that's another very bearish sign. Okay. So, all of those things combined is what you need to be looking at. Now, if we look at the workspace here, which gives us our overall viewpoint of the market, we can see, well, we already spoke about the SPX, but we look at the NASDAQ here. What an incredible run. And this is something that I called, and you can go back and look at my video several weeks ago. I was expecting the NASDAQ to have a significant move higher, and we've certainly seen that. So that's very bullish right now, well above the 21 EMA. The Dow Jones Industrial Average, that's above 33,500 there. That's still bullish and above the 21. But if we look here at the transports, we can see that they're starting to trend down here. Below the 21, starting to trend down. And if you have a look here at the transports, we've got this trend line here, which has been in play for a long time now. If you start to see, I'll just bring this in a little bit. If you start to see the transports closing below this trend line, this lower line here, that's very significant as well. And what you'll find with the transports is they tend to lead the market, sometimes by several weeks. So the fact that this now is starting to break down is a bearish sign, right? And so, especially if it closes below this lower trend line, okay? We look at the Russell 2000. That's been in a trading range, not really going anywhere. It failed at the upper trend line of this trading range and is below the 21. Had a significant move on Friday, though, up over 2%. But so I would say the leading indexes, which are the Russell 2000 and particularly the transports, which lead the market by several weeks, they're bearish right now. The other three major indexes are bullish, and we will wait and see what happens there. If we look at the overall sectors here, okay, drill down a little bit further into the market, we can see technology, the largest sector here, very strong, above the 21 EMA. Healthcare doing very well also. Yeah, just about all of the major indexes that we track here are above the 21 EMA except for energy. So not a lot of bearishness here either. Okay, so at this point, we would say that this market is certainly not showing us immediate signs that it wants to move down. But they're the things that you need to look for. I hope you found that useful. Now, one of the stocks that we spoke about last week was APPS. So let's have a bit of a look at this. I'll try and give you guys a bit of an idea of how I manage my risk with my position. So if we look here at APPS, now we spoke about this stock and we said, look, we want to be defensive because we had a high skew reading and a whole range of other things I spoke about last week. So we only want to find the very best growth stocks that have great fundamentals, and we want to utilize the power of options to make money from those. So we can see here that APPS has had a pretty decent move down actually, but what it's done is it's bounced off the 200-day moving average here on Friday. So this is obviously going to be very important that it holds this 200-day moving average, and we will see. But we were happy to own this stock in the long term, for the long term, right? You can see here without any indicators on here that this is a significant level of support as well. Just happens to coincide with the 200-day moving average. So it has moved down. 77.50 is where it was when I spoke about it with all of you last time. And it has had a move down all the way down to 64.29. So let's look at the position that we actually have on right now. Now, what we did is we actually set up an in-the-money collar trade. Okay. Now, this is like a covered call with a protective put option. We don't always do covered calls. In fact, many times we don't, but we did in this particular case. You know, we do things like time spreads, diagonal spreads, vertical spreads. Sometimes we just buy the option itself, right? We do a whole range of things, but in this particular instance, we bought a very fundamentally sound growth stocks with great potential going forward that we were happy to own. We bought the stock at $77.50. We sold the in-the-money 75 call for $10.40 or $1,040 per contract. So if you had bought 100 shares, you could sell one call option against those 100 shares. If you bought 1,000 shares, you could then sell 10 options against those 1,000 shares, right? One option controls 100 shares. So in this case, we sold the in-the-money 75 strike call. So what does that mean, Sean? That means that I'm agreeing to buy the agreeing to sell the stock at $75. But Sean, that doesn't make sense. Why would you buy it for $77.50 and agree to sell it for less at $75? Well, don't forget you've made $10.40 per share that you own in income. So have a look at this. $77.50 that you bought the stock for minus the $10.40 you received for selling the 75 strike call means your cost basis, or the real break-even price, what the shares cost you, is only $67.10. Okay, so $10.40, the premium we're bringing in, minus what we paid for the shares, 13.4%. So what does that mean? It means it has to fall more than 13.4% for us to be losing any money. Now, in this case, it actually has. So what's going to happen here? Well, if we look at if the stock finished above 75, which doesn't look likely at this point, although we still have around 5 weeks until the 20th of the 8th, which is when this 75 strike call option expires. So if it was to finish above 75, right, we would make a 10.2% return, which is fantastic, right? 10.2% return in 55 days is incredible. But in this case, that doesn't look like it's going to happen. So what happens here? Well, we keep the $1,040 for selling the 75 call. We don't have to sell the shares, and then we will just sell another call option against that for, say, the September contract. And then we can do it again in October, November, December, if that's the way that this plays out, right? Now, what we also did is we bought some cheap insurance here that expires this Friday. So what we'll do is we'll sell this now, because this insurance that we bought for $38 a contract is now worth $263 a contract. So what we're going to do is we're going to sell the 65 strike put, bringing in a very nice return there of $225 per share, right? We're protecting ourselves here. We've actually made a profit of $225 on that one put option, okay? So this is a very nice scenario. So we're going to actually sell this 65 put now, bring in another $225 of income, because we've made a profit here, $263 minus what we paid for it, $225. $2.25 per share. We've got 100 shares, $225. Okay, so this will actually reduce our break even further, right? So if we look here at 67.10, which is what our break even was without the put option, without the insurance. If we look at it now, 67.10 minus our $2.25 we made, our break even is actually $64.85. And have a look at this. What's the actual price of the stock? $64.29. So we've lost virtually no money at all. We're down just a little bit here, and the stock's had a significant fall from $77.50 all the way down to $64. And we haven't really lost much money at all. Now, if we stay in the trade, which we will, we can then just sell call options against this fundamentally sound growth stock again next month and reduce our break even further again. So it's a fantastic strategy when you have a great stock that you're happy to own. And in this case, we've managed our risk very, very well. So that's the way we're actually managing this actual live trade as we speak. So, that's called a collar trade. It's just one of the many things that we do here at Cash Flow Options. So I hope you guys found that useful. You know the key things to look for in the market. This is a trade that we are in right now, and we look forward to teaching you more things and seeing how this market unfolds over the next several weeks, particularly with earnings, right? Keep a very close eye on earnings, because have a look at this. We are going into earnings season. Don't forget that. And this is going to really dictate where this market goes. If you look here at Earnings Whispers, you look here in the first week of August, look how many of companies are actually reporting their earnings, right? 272 companies before the market opens, 366 after the market closes. So it's a significant amount of companies are reporting their earnings. And, this is going to have a big impact. Are they going to beat expectations? Okay, are we getting the actual earnings that are going to be higher than what the experts expected them to be? If that's the case, we're going to continue to move up. Despite the doom and gloom, despite what anyone else says, look at what the earnings are. And you can see the next couple of weeks, if we click through the next couple of weeks, we can see that, there are a lot of companies reporting their earnings, particularly in the first week of August. A lot of companies really starting to report then. So these next few weeks are going to be very important to dictate where this market is going to go. And a lot of it's going to be determined by the earnings. Okay, so keep a close eye on major companies reporting their earnings. If they beat expectations, we're going to continue to see this market go up. And either way that it goes, though, we're going to manage our risk and continue to profit. All right, my friends, I hope you found that useful. I'll talk to you all again next week. My name's Sean Allison. All the best, and bye for now.